In this presentation, we will take a look at an example problem related to a not-for-profit organization with one program. So a not-for-profit organization, not a governmental organization, a non-governmental, not-for-profit organization, one which has one program. We're going to have our information up top. We'll then record the journal entry down below, and we will be posting that journal entry to our trial balance worksheet. The trial balance worksheet will be in order with the assets in green. The liabilities, we have none for this problem. This will be a shorter problem. They would be in orange. Then we would have the light blue. The light blue is going to be what would be equivalent to the equity section in a for-profit type of organization, here that being called net assets. You'll see here that we have net assets with donor restrictions and net assets without donor restrictions. That's going to be one of the new kind of things in a not-for-profit that we do not see in a for-profit, which we will have to account for. Under that, we then see contributions, and this is going to be, well, the dark blue accounts, first of all, will be similar to the income statement accounts, revenue and expense type of accounts in a for-profit type of organization. Similar process here. Those will be the temporary accounts, the timing accounts, those that measure performance over time, those accounts that will eventually be closed out at the end of the time period to what would be the equity section in a for-profit organization, here being closed out to the net assets section. You'll see that, of course, the names will differ, but the concepts will be the same in terms of temporary accounts measuring activity over time, similar to revenue and expenses. However, once again, what will differ is that we have the contributions with donor restrictions, or without first, and then the ones with donor restrictions. We're going to have to be breaking out then, we're going to label them by account, which ones are going to be with donor restrictions and which are going to be without donor restrictions. We're also going to have this reclassification type of accounts down here, which will be reclassifying something out of something that was previously restricted to something that no longer has restrictions. This is going to be one of the new type of things we'll have a look at in this presentation. This is one of the things we want to concentrate on as being different in a for-profit to a not-for-profit, different in this not-for-profit as compared to a for-profit. And then we have the program expenses. Okay, so we're going to start off here. We've got the cash donation with no restrictions. So we have a cash donation, the $36,800, cash donation with restrictions to spend on a Christmas dinner. So we have dinners that are going to be provided, meals provided for the nonprofit organization. We have two types of donations, one with a restriction to the Christmas dinner, one with not. We're going to record this as one transaction. You could think of them as two separate transactions, but we will record it as one. The cash then totaling the $36,800 plus the $5,800 for the $42,600. That's going to be the debit to cash. Then we have the contributions without donor restrictions. This is similar to income because this is kind of like the income account. It's going to be going up in the credit direction. It's going to be going up for the amount that does not have restrictions for this first account. Without donor restrictions, it goes up in the credit direction. Then we have the next $5,800. It's going to be a credit to the contributions with donor restrictions, which will be this second account. Similar kind of revenue account, however, broken out between those which do not have restrictions and those that do. If we then post this, we can see that we have cash. Cash is going to be posted up top to the cash amount, increasing that. We have the contributions without donor restrictions. Here's the contributions without donor restrictions, increasing in the credit direction. And then we have the contributions with donor restrictions, increasing in the credit direction. Notice over here that credits are being represented by brackets. And over here we have debits and credits being represented by both columns, debit, credit column, and by debits being positive, credits being negative. On this side, in order for us to see this quick type of worksheet in a very easy way, we're going to represent the credits with negative numbers and debits with positive numbers. If we add up the debits and the credits, the 42,600, for example, the 36,800 and the 5,008, it adds up to 0. Debits minus the credits equals 0. We then are in balance. This number represents kind of like what would be the net income number, which is all the dark blue accounts, revenue minus expenses, revenue being greater than expenses, credits being higher than debits with regards to the income statement type of accounts, the statement of activity type of account. So this would be similar to net income, the change in net assets. Okay, next transaction. We have goods donated for production used immediately. So we're going to have the goods that are going to be donated and used immediately. Now, we're going to say that our primary objective is here to serve meals. So we'll say the goods are basically meals that are going to be provided to the organization. The organization then takes those meals and uses them immediately in accordance with what they're designed to do as the nonprofit organization to provide meals to the needy for meals. So we have then what we're going to do then is debit program expenses for the 9,000 and credit contributions without donor restrictions. So in other words, we can't think of this as combining kind of two transactions together. You could also think of this transaction as saying if the goods were donated, you could debit basically supplies, some type of supplies account, and then credit the contributions, which is a type of revenue, because once again, it's a donation, which is in essence kind of revenue, a type of revenue in essence to the organization. In other words, the temporary account for contributions will then be increasing in the credit direction. We could then have put it into supplies. Then when we consume the supplies, debit the program expenses and credit supplies. However, if we're going to be using them at the same time, we can basically combine them together in one journal entry as is but done here, debiting the program expenses because we've consumed the supplies that have been given at the same time, that being an expense, crediting the revenue because basically that donation that was given to us is a form of revenue. So that's going to be our transaction. If we were to post this then, we're going to say the debit to the program expenses is going to be increasing the program expenses in the debit direction. So it's kind of like an expense going up, which would bring the equivalent to net income or the change in net positions down. And then the other side is going to the contributions without donor restrictions. Now, obviously, if we gave food to a charitable organization, groceries, then you could say, well, it's pretty restricted there. We can only use it for basically groceries, right? You could try to sell it and spend cash on something else. But note, the donor, the person who gave the groceries, didn't say you have to use these groceries for a specific purpose. Therefore, we're saying it does not have restrictions. Obviously, the type of gift makes a restriction, but that's not what we're talking about with the types of restrictions here. There was no restriction request on the use of the donation in the form of groceries. Therefore, it's going to go into the account contributions without donor restrictions. So that's going to be increasing this amount, of course, because it was a credit balance. We are increasing it in the credit direction, so it increases there. It nets out, of course, on what would be equivalent to net income, the change in the net assets, because we're increasing an expense and we're increasing the revenue. We're back in balance given by the green zeros. Next transaction. We have labor contributed for non-technical service. The estimated value is $2,500. Now, if we're working in a not-for-profit organization, we're serving meals, we can imagine much of the labor that would be donated to the not-for-profit organization would be in the form of things like preparation, cleaning up the area, and those type of activities. That's going to be what we're going to call non-technical activities, as opposed to kind of professional activities, the most common examples being something like a legal service or something like that. Possibly the bookkeeping service would be the professional type of activities. So if they're not professional activities, we're not going to have a transaction for it. So in other words, if people are donating, when people donate their time, we're not going to record a transaction related to the value of the time that is donated. And if you think about that, you might think, well, that's kind of weird. Why wouldn't we do that? If you think about it, you're going to say, well, we should take the value of the time that is provided, and then we would increase the contributions with a credit, and then we would increase an expense related to basically the labor that was donated. But note, if you think about that, it could be a little bit difficult to do that with non-technical labor, because I mean, in a charitable type of organization, if you have some type of drive or some meals that are being provided, it sometimes can be difficult if you have the labor that is donated to determine how much of that labor is actually labor that's being laboring in the process of making the meals, and how much people are basically they're not doing a whole lot of labor that are included in the charitable type of organization. It's kind of difficult to measure the donated labor for non-technical service to really think about what the value of that would be. So if you were able to do that with non-technical service with relation to labor and value it, there could be some distortion that could possibly happen there, given the fact that it's not the most easy thing to value. Now, if you're talking about technical labor, something like a legal service or bookkeeping service, things that are going to be more of a technical nature, then the idea, the concept would be that if someone's going to provide those more technical type of services, they would do so and be able to estimate the value of those services more readily, and then possibly record those technical services. So just note, this is going to be a common type of question, common kind of difference in a test question. Common type of question will be, labor contributed. What's going to be the transaction? None, which is kind of like one of those type of tricky kind of questions. And in the for-profit situation itself, you're going to have those types of questions as to, if we have the donated labor, when is it a point in time that we should be contributing or making a transaction related to the donated labor, and when is it a transaction that doesn't warrant a transaction on the financial statement? Non-technical labor, typically no transaction. Next, we have federal grant received for equipment. So we have a federal grant that was received for the purchase of equipment. Transaction related to that is going to be a debit to cash. So the federal government, in other words, gave the not-for-profit organization money, that money to be used for a specific purpose. That's typically how the grants will be. So whenever you see something like a grant, typically they're going to say, here's the grant, but we want you to spend it somewhere, which means that there is a restriction then on the money that we're going to receive. So we're going to say cash is going to go up. Great, we got cash. However, we can't spend it on anything we want. We would never spend it on anything we want, of course. We would spend it only on the objectives of the not-for-profit organization. But we are even more restricted than that in this case, because we have the restriction to spend it on some part of equipment, some type of equipment. Therefore, we're going to basically credit contributions, a kind of revenue account. However, it will be the contributions with restrictions. That's the one we don't like as much as the not-for-profit organization. Why? Because we have to track it separately, and then we have to make sure that we spend it properly on whatever is it meant to be spent on. And as we do so, from a bookkeeping standpoint, we need to make sure that we unrestrict that as we go. So our goal here, note, anytime we have something that's in basically this restricted area, our goal is to try to unrestrict it at the non-for-profit organization, right? We want to make sure that we want to get to the point where these funds are going to be unrestricted, so that we then have no restrictions as long to spend them in some kind of way that's the general format that aligns to our not-for-profit organization. Okay, so we'll see that in the future. Here we're going to have the cash. Cash is going up. We're going to be debiting cash. Cash is a debit bounce, goes up in the debit direction. Then we're going to be crediting the income account, the income type account, contributions, however, the one with restrictions. So the credit balance account of $5,800 goes up in the credit direction to $11,800. The effect on what would be kind of like the net income, the change in the net assets, is an increase here as well from $42,600 to $48,600. Next transaction. We're going to have the purchase supplies for Christmas dinner. So now we're purchasing supplies for that Christmas dinner. That's going to be, you'll recall, one of the things that we had a restriction for in a prior transaction where there was a donation. However, it was restricted to be spent on the Christmas dinner. So now we're spending it. Now you might think, hey, we would be doing this Christmas dinner thing anyways as an organization that serves meals. However, with that money that's restricted, then we want to make sure that that money in particular, as we spend the money on the Christmas meals, we're kind of counting that money as if it's like the first funds that we're spending on the Christmas meal. In other words, we're saying, hey, there's some restrictions up here. Part of this restricted funds in the net assets, or what would be the net assets if we close everything out, part of the restricted funds that we have are related to or need to be spent on Christmas meals. If we then spend money on the Christmas meals, we will of course make the assumption that the first dollars that we spent were from those restricted funds. That's how I would think about it. So that then you can transfer, once we do this expense, we can take the money out of the restriction and then make it unrestricted. So there's two transactions that are very important from a bookkeeping standpoint. One is just to record the actual supplies, which we will do here. But then the second transaction, making sure that we unrestrict anytime we have the opportunity as the nonprofit organization to unrestrict money, meaning we spent money on something that had been a restriction to funds, we need to make sure to unrestrict it at that point in time. Our goal here is always to, whenever possible, according to the rules, unrestrict the money that has previously been restricted. So the first transaction will then be the program expenses are going to be debited and the cash is going to be credited. So if we take a look at that, we're going to say, all right, then the program revenue, that's going to be the debit. It's going to go up from a debit of 900 up by the 4,500 to 4,000 to the 5,400. And then the cash is going to be credited. So we got the cash here. The cash is going to be going down and it decreases the cash. Now, as you can see, we're basically assuming that the purchase of supplies is going to be close to the time that we actually have the Christmas dinner. So we are actually expensing the supplies at this point in time. We're not putting the supplies up in the supplies section and then as an asset. We're not putting the supplies as an asset and then when they are used, removing them from the asset and expensing them. We're assuming here we're purchasing the supplies specifically for the Christmas dinner and therefore expensing them at the point in time of purchase. Now we're going to have the second part of the transaction. So, and that's going to be these two accounts. So these are the two kind of new accounts that we want to be familiar with. So we need to be able to track all the things, all the reasons that we had restrictions in funds. We know that one of the reasons here was because of the Christmas dinner. We spent money on the Christmas dinner. We assumed that part of that money was from the money that was given to us and restricted, and therefore we're going to unrestrict that money now. So the way to do that is we have these two accounts. They're called net assets released, satisfaction of purpose restriction without donor restriction. There's the key word, without. And then net assets released, satisfaction of purpose restriction with donor restriction. So the way I would think about these two accounts are like they're revenue type of accounts. They're kind of like revenue type of accounts. This first one without donor restrictions, that's where we want it to be. We want to increase that one. So we're basically always going to be increasing the one without donor restrictions because the purpose of these two accounts is to transfer from things that are restricted with restricted to items that are without restricted. Therefore, the one without restricted is going to be going up. I would think of it as a revenue type of account and has a credit balance. So the way it's going to go up is by crediting it. So this one is going to be credited for the 4,500 that we spent on the Christmas dinner. This one, the net assets with restrictions, I would think of it as a kind of revenue account. We're decreasing it because we're taking it out of this one. It's always going to be decreased when you post to these two because we're removing it from the restricted amount to unrestricted. And therefore, I would think about this as a credit balance account that is decreasing. How do you decrease it? You debit it. So we're going to debit that one. And then if we post this out, we're going to say that we have the debit going to the net assets with, this is the one with restrictions. That's going to be here in the debit direction. And this is the one that's going to be going to without restrictions in the credit direction. Obviously, it nets out in the bottom line number and what would be kind of like the net income number, the change in the net position. So you might say, why are we doing this? What's the point of this? And of course, the point is to transfer from the contributions with restrictions to without, to take it out of the restricted area. So you can kind of think of this as almost like an intercompany transaction or almost like a funds type of transaction. It'll make more sense when we actually make the income statement equivalent type of statement. The income statement equivalent is going to be the statement of activities. When we do that, we'll have two columns. One column will be with restrictions and without restrictions, and one column will be with restrictions. And these two transactions will then show the one without restrictions going up, the one with restrictions going down. The total, kind of like an intercompany transaction or funds, inter-fund transactions for governmental accounting, will show zero because nothing really happened except for an inter-fund or an inter-account, intercompany type of activity. One type of kind of fund transaction going up, one going down. So that's going to be what it looks like here. Here, note, it's a little confusing to look at because we're trying to imagine two columns that are happening just on a trial balance. And the only way we can do that here is by basically labeling these accounts with and without restrictions. And that's a little messy to do. However, so when we start to see it in the statement of activities, then you'll see those columns that will be broken out, and it'll make it a little bit more clear how that transfer looks in the statement of activities. We'll see that in a future presentation.